All right, everyone, thank you so much for being here today. My name is Emily Spranger. I'm an academic trainer in the Center for Teaching and Learning, and we are thrilled to have Dr. Erin Brown joining us again. Dr. Erin Brown is faculty member in the School of Business and Economics. And I'm gonna go over just a couple of housekeeping things before I kick it over to Dr. Brown. We are recording our webinar as always, and I will post this in the CTL webinar section after it's done, about 24 hours after we're done processing the video. Absolutely, Dr. Brown wants you to have conversation in the chat. We welcome that. Ask any questions that you may have in the Q&A, and we'll get to those as we pause or time permits. If you do want to see the scrolling subtitles of this webinar, you can hover over the bottom of your Zoom and hover over the CC option and hit show subtitle. If it is a distraction to you, you can also hide those subtitles as well too, and you can find me in the chat if you're having any technical difficulties disabling that. So I think that about covers my housekeeping pieces. Dr. Erin Brown is going to be covering the anatomy of Tesla stock today. And of course, there will be some room for discussion as well, too. I know he has a couple of things that he wants to cover. So I am going to pass it right on over to you, Dr. Brown.
Awesome. Thank you so much, Emily. Always a pleasure to come and do these webinars. I really enjoy it. And it helps me make sure that I know what I actually say that I know. So that's always a positive as well. So I'm going to share my screen real quick, everybody. Let's do it. Okay, guys, we are going to talk about the anatomy of Tesla stock this morning or this afternoon or wherever you may be in the world. So today's agenda, here are what our goals are. Security analysis, Tesla, and we're going to wrap it up. We're going to do all these things. So it'll be great. Okay, as far as goals, guys, we're going to pretend that Thomas and Chloe want to be millionaires by investing in Tesla stock. And we're going to figure out, is that a good idea? Is that a bad idea? Is the goal wrong? Let's find out. Okay, but before that, I have a book recommendation for you all. I'm actually buying this as a gift to my father-in-law and my 4 brother-in-laws for Christmas. It's George Clayson's The Richest Man in Babylon. And it's a great little read. It's a short book, and I think that you'll really dig it. So just a book recommendation. So I want to start out with asking the question of what is an investor? So this comes from the question of, are you a speculator or an investor? We don't really talk about speculators in our common vernacular in Wall Street finance spheres like that anymore. But our definition for an investor is an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So let's hone in on the first one, a thorough analysis. We want to do a thorough analysis of the stock. And that emoji is just super excited to be part of that thorough analysis. Forgot to delete him. And then promises safety of principles. So what this means is what you pay for a security, for a stock, for a chunk of Tesla, is you're not going to lose it. Like you're not going to lose it as it like drops in value. Instead, there's going to be an adequate return. I think adequate is a very important word. What it means is we are not looking for exorbitant returns. We're looking for adequate, reasonable returns. And there's an important distinction in that we'll unpack. And then finally, if operations not meeting these requirements, operations not meeting these requirements are speculative. So, thorough analysis, promises safety of principal, adequate return. That's what we want to think about as we are analyzing Tesla today. So, speculation, again, just because you own stocks and bonds doesn't make you an investor. Speculation can be intelligent. Speculation can be unintelligent. But let me say this, speculation is important because without speculation, we wouldn't have Tesla. We wouldn't have Amazon. We wouldn't have Netflix. There are important points in time where speculation is a vital part of this process. Number one, over on the what would be my right-hand side of the screen, speculating when you think you are investing. You want to watch out for that. Speculating seriously instead of as a pastime when you lack proper knowledge and skill for it. We'll talk about that just a little bit more when we talk about Robinhood. And then risking more money in speculation than you can afford to lose. So if you were around for like the late 90s, early 2000s, the stock market was getting hot in the late 90s before the 2001 recession. And we found that people were borrowing money on their credit cards to invest in the stock market. And there is no way, well, I shouldn't say no way, but it is not wise. And I don't think it's going to pay off in the long run to be paying interest on a credit card that is greater than the average annual return of the stock market. You're speculating if you're playing with your money. So you will see these two headlines here at the bottom, and let me just magnify those. So in the first headline, charts suggest the market has more upside through the end of the year, Jim Cramer says. Next headline says, hold your nose and sell to brace for a possible market downturn, Jim Cramer says. Guys, as you already, your eyeballs have already moved to that red arrow in the screen, you will see that there is an 8-minute difference between those two headlines. Guys, listen, when we talk about investing and analysis, we are not going to look to headlines like this to make the majority of our informed decisions. Wall Street is notorious for peddling hot stocks when those stocks are at the peak of their performance. That means those stocks are reaching the point where they are overvalued and there's going to be a correction on the market price of that share. And Wall Street also tends to underplay stocks that are at the bottom of the market and are undervalued. So what we want to do is we want to be investors, not speculators, and we want to tune out headlines like this. So let's talk about 2020. I don't know if anyone has ever heard of COVID. It was this thing that happened in 2020. And I've gotten to the point, my wife is a little embarrassed. Like we'll be out to dinner or with some people and someone will say, well, you know, when 2020 COVID happened, and I'll stop and go, what's COVID? And then my wife's eyes like roll. She almost passes out from how hard her eyes roll up into her head. She's tired of it. But COVID happened, obviously. And when COVID happened, the market took a big dip. I remember a colleague from another university reached out to me and was telling me how they had 300,000 in the market. And when the market took a dip, they panicked and pulled their money, and they missed out on becoming probably a millionaire because they sold all their Tesla stock. So we need to understand that market dips happen and it's going to be okay. But then we injected 1.2 trillion into the economy. We also have injected more money into the economy, which has helped with the inflationary problem that we are experiencing now. According to data and statistics, less than 1 out of 3 households actually needed the stimulus money. So we injected a lot of money into the market, and it created consequences, and some consequences are positive, some are negative. So when we think about Tesla, we look at, on January 1st, 2020, it was selling for $43.37. So February 19th, it reached $61.16. The decline in price per share begins. March 5th, 15th, we experienced the Sunday lockdown. March 16th, Tesla is selling for $29.67 per share. It's cut in half. And we'll talk a little bit of why that cut in half. April 20th, stimulus checks. May 1, Tesla's back up to $55.67. And by December 1st of 2020, Tesla is selling for $235 per share. That is ridiculous. Absolutely ridiculous. And we'll unpack that. Here's just some information about the S&P 500. So again, following that same linear analysis of the timeline, February 1, it's 2,954, and by December 1, it made its way back to 3,669. So it was able to correct and make up for lost ground. Dow Jones Industrial, same thing. But there was this handy dandy app called Robinhood. I don't think there's married men with the Robinhood app, and I'll try and stop my dad jokes now. But so the market hits a dip. People in their 20s and 30s get stimulus checks, and they begin buying stocks, some cheap stocks. They're able to buy fractional shares with the Robinhood app. And there's 13 million users on this app. And so what we see, and some of you probably remember, is that the market starts like really going. We see a lot of speculation. That's exactly it. We see a lot of speculation in the market, and there's a ton of speculators. So we just see the market take off. I said for a long time that what we experienced during that period until what we're experiencing now with inflation and the rise of interest rates, my opinion is we've been living in an artificial stock market. It was too hot, too fast. And I think if we look at the trends, it probably wasn't going to perform the way it was. But because of this injection of money and trading and the increases in volume, we start seeing the market take off. So what is an investor? Oh, it's an operation. An investment operation is one in which, upon thorough analysis, promises safety of principal and adequate return. That's what we're looking for: safety of principal, adequate return, and analysis. So in 1929, many of us know what that is. 2008, we had our financial crises, the biggest ones. Stock market crashes. Now, I don't like to say crash. I prefer the term correction. All stock markets throughout history correct. And the reason they correct is because we reach a point where we realize the value of the market is overvalued. And there needs to be a correction back to what the value should really be. But if you asked analysts leading up to the crash in 1929 and 2008, they would have said, this market is overvalued, it's stupid, and it's all speculation. It's not investment, it's speculation, and this market is stupid right now. So serious analysis suffered, and this was due to the persistence of imaginary values. And what I mean by that is people wanted the price to go high, and they thought that these prices were just going to keep going higher and higher and higher. And that's just not a reality. And it was the disappearance of real values. So because consumer sentiment was so hot, securities and other investment vehicles were just way overpriced. So intrinsic value versus market price. So intrinsic value is an elusive concept, but it can be elusive, but it's justified by assets, earnings, dividends, and definite prospects. It's distinct from the psychology of the stock market. Like we want to say, how much do we really think this company and security is worth? The market price is the current price of security stock can be purchased or sold. And there's a lot of factors that go into this. And the goal is to establish an adequate, again, our favorite word for the afternoon, an adequate intrinsic value in order to justify the purchase of a stock. Emily, I'm going to pause for a second. Do we have any questions?
So at this time, no, I don't have any questions that have popped up. I am curious if there's been a definition of what is adequate. What does that mean?
So Benjamin Graham, who is like God when it comes to investing, he is the one that Warren Buffett studied under.
Okay.
And way back at Columbia University, 1950s, Benjamin Graham is very much responsible for a lot of how we look at investment and analysis today. So when he says adequate, he's saying reasonable.
Okay.
Yeah, and he's saying like, and I mean, we could walk through a ton of examples. We don't necessarily have the space for that. And I know you're not asking for that, but we could walk through examples where, wow, this stock took off and really you should sell it because it's going to crash. It's going to correct because the returns aren't reasonable. They're not adequate. So Graham would recommend stocks should increase in sales and value from about 5 to 7% over a given period. Like that should be the average of return for 7 years. So I don't know if I clarify again, it's that issue of elusive but justified.
No, I think that does clarify it. A question in the Q&A, just because I think this is a good point.
Sure.
Were the Tesla prices that you showed just a couple slides ago, the then prices,
Yes,
not reflecting the recent split value?
not reflecting recent split
Okay.
because they hadn't split yet.
Okay.
They wouldn't split until somewhere in late 2020, and then it split again in 22, I believe. I could be off, but I know it split this past year or like August of this year. I may be off on the 2020. So
okay, we won't quote you directly. All right. All right, Dr. Brown, that's it for now.
Great. Okay, so guys, I've got a handy dandy chart with you, and I will give this to Emily in case anybody wants it, or maybe we'll just have you guys email me and I will, okay, great. Emily's got it. So relationship of intrinsic value factors to market price. Again, we're talking about the difference between speculative and investment. So with speculative, we're going to look more at market factors. So technical, manipulative, psychological. What in the market is driving the value of this stock? And speculative also uses future value factors. So management and reputation of the firm, and we'll unpack these a little bit more. Competitive conditions and prospects. So what will competition be? What do we think competition will be like in the future? Possible and probable changes in volume, price, and cost. Will demand remain constant? Increase? What do we think that's going to happen? So as you can see in letter B, investment also uses future value factors, and it uses intrinsic value factors. So earnings, dividends, assets, capital structure. And when I say capital structure, I mean the debt equity mix, how much of the operations of the company is funded by debt and equity, and then terms of the issue, and then just other factors. Like when it comes to intrinsic value, there's a lot we can explore, but I'm trying to give you the big ones here. And all of this funnels into attitude of public toward the issue. and bids and offers, and it results in market price. So all of these things, like as much as I want to steer you away from speculation, we have to be conscious that speculation is also going to play a factor in market price. So if you live and die by the market changes every morning, you may get a few days where you're like, man, I'm walking on sunshine because my stocks are going up in value, and then boom, dip. And you'll see this, like it's always doing this, but over the long run is what we want. And we want the long run to do this. We don't need to be worried about all these little spikes and things like that. So therefore, the market is a voting machine instead of a weighing machine. Now, take this with a grain of salt. Okay. All forms of government and economies use economics. Economics is simply the moving of a product into the hands of people who want, need, or can pay for that product. Now, capitalism allows for the democratization, gives people a voice, so to speak, in determining the value of a stock. So again, even in communist countries, there are economics, but we don't have a stock market in communist countries. And, there's a misnomer around the northern Scandinavian countries. People will say, well, those are socialist countries. Those are countries with wide social safety nets, but those are not economically socialist countries. And what I mean by that is socialism is the seizing of manufacturing in a country, or the seizing of the means of production is the quote. So in those Scandinavian countries, their businesses are not run by their governments. Their businesses are run by individuals and entities and boards, and many of those companies exist on the stock market and trade and all of those things. So I just want to, demonstrate that, like those Scandinavian countries, like America and other capitalistic countries, you may not have a purely capitalistic country, but our stock market and the way that we're set up does allow for this democratization. So again, there's our chart, 10K. So you'll see that underline on the 10K with sec.gov. When you get this PDF, you can click on that and it will take you to Tesla's 10K. So real quick, there's 4 parts to a 10K. The first part is an introduction to the company, risk, key business segments, markets, activities. Part 2 is financial data. This is where you find income statement, consolidated balance statements, cash flows, number of investors, and buybacks that the company performed. Part 3 is an introduction to the board of directors and the management team. And part 4 is a list of tables and exhibits. So that's what you'll find in a 10K. And what I would recommend is that you actually take about 5 10Ks. So from the most recent 10K going back 5 years, and just read through them and compare them and see what has changed, what has management followed through on, goals, things like that. And it will give you a much more solid understanding of where the company has been, and it will give you an opportunity to catch items that maybe you wouldn't catch by just reading one. So there's 3 functions of analysis. We're going to stick pretty much with descriptive and selective just for our time today. And descriptive is S&P, Fitch, Moody's ratings. We want to identify strong and weak points of the company. We want to benchmark against competitors and identify and evaluate predictors of future performance. I am drinking a Waterloo this afternoon to quench my thirst, but this lecture is not sponsored by Waterloo. I just want to let you know as I'm quenching my thirst. Okay, So, guys, it's time for a security analysis. Are you ready? Bum, 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 bum. Too much. Okay. Guys, we're going to look at a bond analysis. And we're just going to look at it in overview. And what I mean by that is, again, you can click on that underlying Tesla when you get the PDF, and it will take you to an important link. But when you are analyzing whether or not to buy a company, something you should consider is, what does S&P, Moody's, Fitch, what do they value? Or I'm sorry, what is the credit rating they assign to a company like Tesla? Okay, BB plus for Ford, Toyota A plus, Chrysler triple B. Those Bs are not fantastic, nor are they terrible. Basically, companies have two choices that they can make when they are in need of funding. And one is to go take a loan, but the other is, do we want to issue stock, or do we want to issue bonds to raise money for our operations for future projects? So one way to do that is to sell bonds, because bonds don't give up ownership. They only give rights to the cash flow. So Tesla, Ford, and Chrysler are ranked in the Bs, not the As. And so what this means is, are these companies likely to default on their payments of these bonds? No, but there's a risk. So Toyota, if you want to buy a bond that you know will get paid back, buy a bond from Toyota. You know that that'll get paid back. And we can look at this chart right here. So again, Tesla is right here. Chrysler is right there. I think Ford is here. And then we've got good old Toyota up here at A plus. So these are not, you really want to be up here. I don't know if you can see my cursor. You really want to be up here in the A's and not down here in the B's, but the B's are not the worst thing in the world. Okay. So again, there it is right there. And then we want to just talk descriptive real quick about, so the ratings, BB for Tesla. And then when we're looking at their 10K, we would ask, what are strong and weak points? Well, Tesla will tell you through a 10K, because the 10K goes to the SEC, which is the regulating body, but it's also meant for the investor as well. So they would say, hey, the pandemic's a weak point. Supply chain is a weak point, because we had a global supply chain problem. We still do to some degree. Skilled labor force, people are not as skilled in robotics and some of these other needs, as our population is not as skilled as it needs to be. Our delivery system, are we able to deliver our products? And Tesla has its own delivery process. It doesn't outsource that. And they would say another competitive point is the market of combustible engines. So you looked at the companies that I benchmarked or compared Tesla to. Everybody mostly buys combustible engine cars that are combustible. They use combustible engines. Musk has given away all of his schematics for his cars, hoping for more competition, because he is banking, I think, on being the prospector or first leader of electric vehicles. But still, gasoline is his biggest competitor. Battery raw materials access. So lithium is not as plentiful as gasoline. It's also difficult or challenging to mine lithium. So there are definitely environmental factors that if you have a lithium spill, it may be just as bad, if not worse, as an oil spill. So there are challenges like accessing these raw materials. And currently, our current legislation, powers that be, have tightened up on mining some of these elements and critical materials and forced manufacturers to go to China to get these materials. So there's a challenge. And then I just want to say a strong point, Elon Musk. Okay, let me ask you a question. You don't have to answer me, but who's the president of Ford? Who's the president of GM? Who's the president of Chrysler? Toyota? You don't know who those presidents are. Who's the CEO of Tesla? You know it's Elon Musk. And not just because I told you, you already knew that. He is, for lack of a better word, a pop figure in our world. And he is a great branding of Tesla. And then when you do benchmarks of these companies, you want to do it against those. And then future performance, we want to determine that. So selective. So it's a question of, do we buy, sell, retain, or exchange this stock? Do we want to buy it? Do we want to sell it, keep it, trade it for something else? So we see in 2018, price per share of Tesla is $23 compared to Ford, $10, $11 for Ford. Dividend, Tesla does not pay a dividend. And then under Ford, it should say dividend as well, but it's 15 cents. It would take, I think, 20 years. If you bought one share, I think it would take 20 years to pay back that dividend, to have that dividend pay it back. And then price earnings. Now you're going to be like, whoa, that looks terrible. And maybe it is. Price per earnings, negative 39.1. Price per earnings for Ford, 6.37. So those are some factors that we want to look at, like what is the price per share? What is the dividend being paid, if any, and the price per earnings? Okay, we look at it today, price per share, 215. Price per share for Ford, $13.26. Dividend, it's the same. Price per earnings, negative 39.1, 6.37. Actually, that is not correct. I believe Tesla's price per earnings has been in the positive. So that is my mistake. So we have to ask the question, is Tesla's market price conjectural? Is this just conjecture? Is this the real value of Tesla stock? So the size of the enterprise, and I don't mean this enterprise, for all of you Star Trek fans out there. I love Star Trek. I just want you to know that. I feel like when I share that, it makes us feel closer. So the size of the enterprise, identify the minimum standard size for the industry. What is the market capitalization? What are the shares outstanding? What are the sales levels? What are the total assets of the company? So when we compare Tesla and Ford, again, the market cap, or what we would call the minimum size for the industry and market cap, kind of go together. So 590 billion compared to Ford, 52 billion. Ford has been around much longer than Tesla. Revenue, 74 billion. Ford is double that. And then total assets, 62 billion. Ford has 4 times the total assets of Tesla. So we look at the stock equity ratio, and this is market price divided by debt plus preferred stock. So $177 a share divided by the debt, which is essentially 8 billion, and with preferred stock, 3 billion. And we get something that equals 0.015. Now we would have to benchmark that against some other companies, but these are things that you want to look for. Property value. Okay, what's the value of the property? Well, it's 18 billion for Tesla. And they have certain agreements with municipalities for tax breaks. And then it's a question of, well, what can be sold? What in our property can be sold? Well, they have gigafactories. And maybe one day when they hit hard times, they're able to sell this factory to maybe a new market entrant or something like that. Warren Buffett, who was a disciple of Benjamin Graham, always looked at total assets. So that's why he invested in things like BNSF, the railroad, because he was like, well, the total assets mean something, excuse me, especially when it comes to liquidation. Let's see, taxes and interest payments. So we also want to look at how much is a company paying, how much of their revenue, their cash flow or net income is going to interest payments, taxes and interest payments. This also kind of goes back to the issue of bonds. So Tesla is paying $371 million as of their last 10K. And they cut this in half from their 2020 10K information, but they cut it in half using an accounting, a new accounting standard from 2020. So we want to like kind of stop. Now, I'm not an accountant, so people sometimes get confused and think that finance and accounting are the same things. I did not have a chance to double check this with an accountant friend, but we want to make sure that Tesla isn't always just using these opportunities to cut things in half. Now, they haven't been, but what we really also want to focus in on is how much of that net income is going towards these taxes and interest payments. It should all, for any company, it should be 50% or less. And even 50% can feel very high, but just remember, it should be 50% or less. So we want to estimate the average earnings, and we want to do this over 7 years. So we want to look back 7 years, identify that, average it together, and then multiply by an appropriate capitalization factor. Now, going back, we talked about how intrinsic value can be a little gray, but justifiable. So we want to make sure that we're using a factor that's appropriate. So again, I obviously like Benjamin Graham. So again, he used a factor of 8.5 when calculating some things. Okay, estimate future earning power, average of past data for physical volume, prices received for products, operating margin. We want to take a look at those, average them over the last 7 years, and come up with an idea of where we think Tesla is going to go. Again, we're looking for adequate. We're not looking for, man, I think Tesla is going to get in a street brawl with Ford, GM, and Chrysler. They're going to whoop everybody, and we're going to see nothing but electric vehicles on the road in 2024. That is stupid. So again, we want to have very realistic projections of how we think a company is going to perform in the future. And then we want to estimate future earning power. So future sales in dollars are projected. Again, volume, price level, average future earnings. And we want to look at something like a chief determinant of value. How are we valuing this? And we want to stick with that. So again, earlier you heard me say, don't trust Wall Street projections. Just do good analysis. Do good fundamental analysis of the stocks that you are potentially looking at investing in. And let me I'll be really, transparent with this. So several months ago, I wanted to take advantage of Amazon's stock split. And the best way to take advantage of a stock split is to simply buy it before it splits so that you don't get caught in the volatility. And that can work for or against you. That can work for or against you. And I'm okay with it working against me just a little bit. Like I have a little bit more stronger disposition with that. I did the best analysis I could looking at that Amazon stock. Do I wish that I had waited to buy it? Yeah, I do. I did not anticipate the Fed raising interest rates as high as they did and the psychology of the market affecting my Amazon purchase. So I've lost some money due to the interest rate rises over the last few months, but I couldn't necessarily see that coming. There was only one thing that left me with I think we're at like a market correction, but I think the risk of buying Amazon now was worth the risk of a market correction. So there's some things you're going to have to juggle, or not juggle, but you're like a scale. You're just gonna have to weigh it against each other when you make some of these decisions. My goal is not to sell Amazon stock for like another 10 years. So I'm holding on to it with the analysis that it should pay off for me in the long run. So don't trust Wall Street. Okay, management. Again, we talked about analyzing a 10K. Elon brings notoriety. And whether you like Elon or not, whether you're concerned about his purchase of Twitter, like, let's not get, I'm a big believer in not getting emotional about certain things. Investing is not something you want to get emotional about. You do not want an emotional attachment. You want to try as make as sound a decision as possible with this. Elon is a great brand. Again, you don't know the names of the other presidents of automotive companies, but you know who Elon is. What is the management structure compared to other firms? I think if you go through the 10K, you're going to find it's really not that different. Maybe some titles are different. And then review 10Ks to see if Tesla management followed through on their promises from year to year. Earlier, I said you want to read like several, like 5, and just see if Tesla management did what they said they were going to do. Now, as I looked at it, I was like, yes, Tesla does what they said they would do. And what they said they would do is that they would manufacture more cars and roll out new models. And they're doing it. They've done it. I think that they follow through on their promises. They're not making wacky, highly speculative promises that, oh yeah, this is going to happen. We're going to roll out this big thing. They just say, hey, we're going to do this. And that's what we're working towards. And they do it. That's the kind of management you want to invest in. Financial strength, is there surplus cash, which is good? Or are there large bank loans and senior securities? Not good. Now, the thing with Tesla is Tesla didn't turn a profit, guys, until 2020. So there is analysis to be had based on the fact that they haven't turned a profit in a long time. Actually, if people did the analysis, they may be a little like, should I invest? Because they've been in the negative for so many years. But now that they're in the positive and making sales, we could project something. Dividend record, Tesla doesn't have a dividend. So, there's a book called See You in Hell. It's the story of Andrew Carnegie and the steel trade, his steel empire that he developed in the 1800s. And he was able to build his wealth by insider trading, what we call insider trading today. Today it's illegal, then it wasn't. And he bought stocks that would pay big dividends. We don't have a lot of that anymore. So if a company doesn't pay dividends, then we really want to see them reinvesting their cash back into the company, especially through research and development. Retained earnings, since there's no dividend, what does Tesla do with its retained earnings? Questions: what makes this company grow? Where will its profits come from? So Tesla for years was able to stay afloat by using the tax incentives given to electric vehicle manufacturers through the federal government, tax breaks. Tesla actually has several areas that they make money from. So they sell their cars, and then they also finance those cars if you want the financing, because Tesla sell at $70,000 on the low end. I think their Model 3s are going to be about 30 or 40 coming out. And then Tesla also generates electricity and sells that electricity for their electric vehicles. So those are 3 areas where Tesla makes money. Okay, we're clear on where Tesla makes its money from. You want to walk away from a stock when you're not clear on what its product is. Other problems to look out for. I've got about 12 of these. I'm going to try and race through them so we can get to Q&A before the time is up. Serial acquirer. You don't want a company that's constantly buying more companies. Okay, we're starting to see, in my opinion, a little bit of the collapse of Facebook because they kept acquiring, and now we're seeing challenges that acquiring is not paying off. So funny little play on words and letters, opium addict. So not opium like cocaine, but opium like other people's money. So a company like, I don't know why I'm blanking out on their names. Co-working space, big co-working space. Well, you look at them and you realize that they never turn a profit. They're opening up everywhere, but they're always generating revenue through raising more money to expand the operations of that co-working space. Guys, stay away from that. They don't have a viable product that will sell. Now, maybe you can speculate and play with the market if they ever do IPO, but there's no guarantee because they don't have a positive cash flow. Okay, is there cash flow or do earnings come from selling stock? Again, okay, we're running out of money. Let's do another stock issuance. Okay. Does the company only have one or two customers? That's dangerous. For a small business, for a large business like Tesla, Tesla has many customers. Okay. Does it have a wide moat? Does it have a wide product differentiation? I think Tesla does because it is the leading EV brand in America, maybe the world. So yes, it has a wide moat. And that moat is used to protect it. That's what it means, like a competitive advantage to protect it. Has revenue grown smoothly over the past 10 years? Yes, for Tesla, but again, it stayed in the red for a long time. But we do see that red coming down, I believe, every year leading up to 2020. Remember, fast-growing companies tend to burn out. So companies with that big sales, big leaps, things like that, they tend to burn out quite quickly. You want perennial winners like a Microsoft, Amazon, Google, things like that. Is there an R&D budget? So Tesla dedicates 5% of its net income to R&D. So however net income goes up, they always take 5% to do R&D. I think that's very important. They're trying to stay on the cutting edge. Does EBITDA replace net income? And so EBITDA, if you're not familiar, is earnings before interest, taxes, depreciation, and amortization. Hey, what's the net income? Before we do all the accounting stuff and the accounting magic, what is the actual net income? Tesla earned its first positive cash flow in 2020. Are there unusual, non-recurring, extraordinary charges? Do weird things just kind of keep popping up? From 10K to 10K. As I did my analysis of the 10K, I didn't see weird recurring or extraordinary charges. But hey, this is why you always have a second glance at everything. And then what is the capital structure? So Tesla has 10 million in long-term debt and it's a $1 billion net income company. That ain't not bad. So goals, Thomas and Chloe want to be millionaires by investing in Tesla stock. They probably should have bought in 2020 before the market took off. But in my opinion, I think Tesla, according to these analyses that we did, again, this is not a recommendation. Dr. Brown is not telling anybody to buy anything. But based on the fundamental analysis that we conducted today, I think Tesla is a good bet for purchase. Now, there's a ton of other factors, guys. We didn't talk about earnings per share and share to equity and or PE ratio or anything like that. Those are other things that should be analyzed as well. But based on this analysis, I think we could green light a Tesla purchase. And then that's it. Emily?
Yeah. So several people asked if it would be okay if they could have the PowerPoint. Is that a possibility?
Yeah.
Okay, great. So Dr. Brown will send that over to me. Folks, if you do have any questions, I have a comment here that I'm just going to share here in the chat. just Angela mentions, I think the Tesla restructured its stockholders' equity section, specifically additional paid in capital with the new accounting rule. I am a CPA,
Mhm.
but I have not analyzed the Tesla's financial statements recently. This
Okay.
is not an unethical change in my
No,
opinion.
no. I never meant to say it was unethical. I
Ah,
apologize. I never meant to say it was unethical. It couldn't be unethical because they identify in their 10K, this is the accounting standard we're using. I'm just saying we want to make sure that net income is coming in and there's not just accounting like the EBITDA and things like that. We want to make sure there's actual cash flow is what I'm trying to say. So I understand. No, I was not trying to say it was unethical. We just want to make sure that we're not always working away money.
okay. Thank you so much, Dr. Brown. Another question. There was a slide
Mhm.
that you showed that seemed to show that Ford was a stronger company than Tesla.
Okay.
Is that something that they saw, or maybe they got it wrong? What did they miss on that slide? It might have just been, I remember it was like back, it was
Yeah, it's early slides.
super
So
early.
selective price per share, price per earnings, because Tesla had a negative price per earnings compared to Ford. But again, we want to try and take a look as a whole at everything that's going on. Tesla continues to increase the volume of its product, of what it's selling. And so so I kind of lean more towards Tesla than I do Ford. I don't see anything in the near future that's going to say, wow, Ford's about to take off. Like they're about to really increase their market share. And part of that is what Tesla is able to benefit from, is that they're increasing their market share year over year as more people purchase Tesla. So
Okay.
like if it was me, by Tesla. I'm just saying, like, that's what I told you about my Amazon story. I mean, I've
Right.
lost money on Amazon, but I'm holding it for the long term. And I think Tesla would still pan out to be a solid company.
Thank you so much. I know, and Dr. Brown, you've already given your disclaimer of these are my opinions and my thoughts and based off of your experience. So we respect that for sure.
I'm not going to manage your portfolio. I'm not going to do
I
it.
know, right? I'd actually have to pay someone to do that. Okay, so that's so great. Let's see. What is the capitalization factor to estimate the average in earnings?
Yeah. So what I would say is, again, it goes back to that elusive but justifiable. You have to look at each market and say, well, what is the capitalization factor for each market? Off the top of my head, I don't have that number for the automotive industry.
Okay.
But usually industries are specific with that type of capitalization factor.
Okay, and then there's a follow-up question on that. Is there a definition you can provide us for capitalization factor?
Oh, sure. Okay. So capitalization factor, like we may say that a company earns X amount of dollars in a year. We're going to multiply it. So capitalization factor is like a multiplier. We're
Okay.
going to multiply it by that factor. So maybe the factor is 2.5. Maybe that's the magic number. And so we multiply that income by 2.5 and we say over the next several years, this is what we perceive. And I think actually the slide that I like panicked and didn't recognize for a second was me using Graham's capitalization factor to say, over the next 7 to 10 years, we might expect Tesla to be a $28 billion a year company as far as net income. So that's what the capitalization factor is. I think I used 8.5 on that calculation, but I'm using Graham's number. He stuck to that. He was tried and true with it.
And then do different industries use, for example, like how do they get the factor number? Do different industries use different
They
capitalization
do,
factor?
yes.
Okay.
Yeah. So, I mean, you also see this with, you also see this with just businesses that are being sold from, like, they don't have to be public entities, but they're sold and say, okay, well, what is this company? What is the typical capitalization factor for a company like this when we're looking at revenues? So a lot of times you'll see something like cash flow times 3 or something like that. So we're going to just imagine that cash flow will sort of stay constant, multiply it by 3. We'll say that that's what the company is worth to sell. And then the entity that purchases that company knows that in year 4, they'll start generating revenue off of the sale of it. So I hope that makes sense.
Thank you so much, Dr. Brown. I would like to thank all of our attendees today. Several great questions for today's series. And I'd like to thank Dr. Brown, as always. Thank you so much for coming and sharing your thoughts and providing some insight onto the stock market and specifically for Tesla today. So we appreciate you.
Yeah, thank you.
And everybody take care until the next time. Bye-bye.